Rezolve AI, ticker RZLV, is trading live at $4.12, and it is sinking, down almost 4% on the session. The stock is near its absolute low for the day, $4.12, after opening much higher at $4.35. The volume is significant, at nearly 3.5 million shares, showing that there is a lot of conviction behind this move lower. Now, the expectation when you see a name like Rezolve AI is, frankly, excitement. It hits every buzzword. It's the right sector at the right time. But the reality of what's happening at $4.12 is that a massive, fundamental disconnect is at play. This isn't a stock that's just caught in today's market chop. This is a stock that is in the middle of a brutal, month-long sell-off, down from a high of over $8.40, and today's drop is just a continuation of that painful slide. The market is pricing this as a story that is, at least for now, broken. The common ground is easy to see. Anyone doing online investing is actively looking for the next NVIDIA stock. They are combing investing sites and their Robinhood app for the next great AI play. The narrative is that any company with AI in its name and a plausible-sounding story is a potential 10-bagger. This is the expectation that has fueled so much of the market, and Rezolve, which only recently became a public company, fits that narrative perfectly. It's not a Tesla stock or an Apple stock. It's not a mature giant. It's a high-growth, high-risk new entrant. But that's where the simple story ends, and the reality of this $4.12 price begins. The market is not treating this like the next great AI play. It's treating it like a highly speculative, cash-burning venture that has just had its narrative shattered. Today's 4% drop isn't because of one specific piece of news. It's the opposite. It's a sell-off happening in a vacuum of good news, driven by the lingering toxic reality of the company's financials. Let's be very clear. The company's recent first-half 2025 results, which came out on October 1st, were, on the surface, spectacular. They reported a 426% year-over-year surge in revenue to $6.3 million. They posted a stunning 95.8% gross margin. They even beat Analyst consensus on adjusted EBITDA, reporting a loss of $17.7 million, which was less of a loss than the $18.7 million expected. They raised their guidance for annual recurring revenue, ARR, to $150 million for 2025 and set a $500 million target for 2026. This is the expectation at its absolute peak. Any Fidelity or SoFi Invest user looking at that press release would think the stock should be at $40, not $4.12. So, why is it at $4.12? Because the market, after a brief euphoric spike, has done the math. This is the reality. That $6.3 million in revenue for the entire first half of 2025 is tiny. And to get that, they had an adjusted EBITDA loss of $17.7 million. This is a company that is burning almost $3 for every $1 of revenue it brings in. This is a catastrophic cash burn. The market is looking at this company and saying, you don't have a revenue problem, you have a spending problem. This is why self-investing is so hard. You have to read past the headline 426% revenue growth and look at the net loss. That $150 million ARR guidance is a projection, a target. It's not cash in the bank. And the market, with 3.5 million shares today, that it does not believe the company can reach that target without destroying its balance sheet or massively diluting shareholders. Let's look at that balance sheet. As of June 30, 2025, the company had just under $10 million in cash. But in a more recent update from October, they mentioned two financings in the third quarter totaling $250 million and that they ended September with approximately $230 million in cash. This is the only thing keeping the $4.12 price from being 41 cents. They have bought themselves time, but they bought that time by, in all likelihood, taking on debt or selling equity. This new cash has to fund that massive $17.7 million loss every 6 months, and likely much more as they accelerate growth. The clock is ticking, and the market knows it. So, what does Rezolve AI actually do? This is where the story gets both fascinating and complex. This is not a simple AI model. They are building what they call the indispensable infrastructure for the age of agentic commerce. That's a lot of jargon. In simple terms, they are creating an AI-driven platform for e-commerce. They have a proprietary large language model called Brainpower that they claim is competitive with GPT-4 but has effectively zero hallucinations. They combine this AI brain with a payments layer, especially after their recent acquisitions of SmartPay and Subsquid. The idea is that autonomous AI agents will conduct commerce on your behalf, searching, negotiating, and paying for goods and services. They have partnerships with Microsoft, Google, and even Tether to integrate digital asset payments. It's an incredibly ambitious vision. It is exactly the kind of story that investors on the Robinhood stock trading platform dream about. The problem is the execution. The expectation is an NVIDIA-like SAS model with 95.8% gross margins. The reality is that analysts are noting a projected contraction in gross margin because the company is now launching a professional services business to get customers onboarded. This is a classic ugly sign. It means their product isn't a simple plug-and-play investment for customers. It requires expensive, human-led help to install. This kills the SaaS narrative. Furthermore, analysts have already revised their full year 2025 revenue forecast down to $46.4 million, citing timing of customer deployments. This is a massive red flag. It's corporate speak for, our customers aren't signing up as fast as we promised you they would. This is why the stock is in free fall. It is a classic de-SPAC story, a company that came public with world-changing projections and is now meeting the harsh reality of a quarterly earnings cadence. The stock has been public for less than a year, and it has already traced a perfect mountain, from its lows near 107 to a high of 845, and now all the way back down. Every rally has been sold. The 100-plus enterprise customers, including H&M and Ferrero, are impressive. But the market is saying that these customers are not paying enough or are not scaling fast enough to justify the company's $1.3 billion valuation and its insane cash burn. Comment below. Do you think Rezolve's $500 million ARR target for 2026 is a realistic goal, or is it just guidance to keep the stock alive? I'm curious what you all think about these long-term projections. For now, the analyst community is, shockingly, still bullish. This is the great disconnect. You have 12 analysts with a strong buy consensus. Their average price target is $7.91, with some as high as $10.50. Cantor Fitzgerald, Roth Capital, and H.C. Wainwright all have buy ratings. This is where self-investing gets dangerous. You look at your Fidelity mobile app and see a $4.12 stock price. You look at the Fidelity trading platform and see a $7.91 average target. The expectation is that the stock is an easy double. The reality is that the stock is treating as if those targets are pure fantasy. The institutional ownership is also very telling. While firms like BlackRock and Vanguard are on the list, so are hedge funds like Citadel and Susquehanna, who are likely trading this volatility, not making a long-term investment. This is a battleground stock, not a buy and hold for your Fidelity IRAs or a Schwab Intelligence Portfolios account. This is a name you trade on interactive brokers, if you can stomach the ride. So, what is the future for Rezolve? The bear case is simple and powerful. The $230 million in cash is a ticking time bomb. The cash burn continues. The professional services arm proves that the 95.8 margins are a fantasy. The $150 million ARR target is missed. The company is forced to do another highly dilutive financing in 2026, and the stock collapses back to its $1.07 lows. The bull case, which the analysts are clinging to, is that this is just growing pains. They argue that the company is investing for growth, not just burning cash. They believe the agentic commerce narrative is real and that the acquisitions of SmartPay and Subscribe